I was once told during my early trading and investing days by a very, very wealthy Jewish trader and investor. He said that is not merely good enough to just survive. No. It's all about thriving, not surviving. And he indicated to me, he said, Kenneth, very few people know this, but one of the easiest ways to become wealthy is to invest what society needs, for you will get paid all of the time. However, when you invest in what society wants, you get paid some of the time. And as he was getting in and stepping into his limo, he said, that may not mean anything to you now, young fella, but the sooner you realize that what I just told you has value, the sooner you will become wealthy. Family members and listeners alike, utility stocks can best be described as the four-door mid-size sedan of equity investing. Boring, to say the least. Nothing sexy about utility stocks. They get you from point A to point B. And investors own utilities for steady, above-average dividends, just as people buy bland, mid-size sedans, because they need something that just works and works consistently. But sometimes both can seem overpriced. In 1987, the base price of a new Honda Accord was around $9,795. Today, that base price is around $22,455, which implies an annual price increase of 4.3%, 33.5% more than the average annual inflation rate of 3.22% for the same time period. So while that mid-size sedan may seem like a bargain, it has gotten slightly more expensive over the long haul. Now, utility stocks also outperformed inflation during a similar run. The average yield of utility stocks over the last 25 years has been 3.96%, while inflation has averaged around 2.1%. And I'm talking about for the same period of time. Now, over the long haul, dividend-paying utility stocks delivered exactly what they should, which is to keep pace with inflation. But sometimes utility stocks like the boring sedan can look expensive. The sector has been dealing with this as of late. Now, after a post-election dip that coincided with a significant short-term move in Treasury yields, remember, utility stocks are always interest rate sensitive. Utility stocks prices have recovered to last year highs. Now, investors looking for added quality utilities, and if they're looking to add them to their portfolio, they are challenged to find real value in the space. So at this particular time, I'd like to present to you 3 positions that I found that fit the bill. First position, write this down, is Entergy Corporation. Entergy, spelled E-N-T-E-R-G-Y Corporation, trades under the symbol ETR. Listen to me closely. With over 30,000 megawatts of aggregate generating capacity, Entergy's footprint covers Arkansas, Texas, Mississippi, and his home state of Louisiana. Now, on a forward PE basis, the stock trades at an attractive discount relative to his peers group. Now, the S&P 500 members in the utility sector trade at an average forward PE ratio of 17.5. Energy shares trade at a PE of 15.6, a discount of nearly 11%. Now, the untold growth story is the energy, particularly oil and gas infrastructure build-out that continues throughout the company's region, is vitally important. The liquefied natural gas, or LNG, space is especially compelling due to a recent inked exporting agreement between the United States and China. Now, a newly relaxed regulatory environment will also be a plus, and ETR shares currently trade at around $76 plus or minus, with a 4.6% dividend yield. Energy Corporation, symbol ETR. The next position I want to give you, talking about utility utility dividend paying positions that will get you PAID, and the uber wealthy know this. The next company is National Grid, symbol NGG. National Grid, symbol NGG. Now, this company is headquartered in the UK. And NGG focuses on electricity and natural gas distribution in the United Kingdom and the northeastern United States. Again, the LNG export story has a play here as well. The company has also been ramping up LNG storage capability in the UK just as U.S. exports begin to ramp up. Now, on a fundamental basis, there's also a growth story in NGG's earnings per share. Full year 2016 EPS grew at 21% clip year over year, coming in at $3.60 versus 2015's results of $2.97. Now, 2017 revenue forecasts call for a 7% increase over 2016, which could also pave the way for an upside earnings surprise. Now, at somewhere around $69 a share, NGG trades at a 15% discount to their 52-week high, and it pays a 4.3% dividend yield. Once again, beating our threshold, family members, to keep up with inflation at 3% as it relates to the dividend yield payout. And the third position I want to give you is a position that the uber wealthy know about, but very few people know about, as is with any of these positions. But this one is extremely attractive. I'm talking about Gabelli Utility Trust. Gabelli Utility Trust trades under the symbol GUT. Gabelli Utility Trust trades under the symbol GUT. Now, diving back into the closed-end fund pool, the Gabelli Utility Trust has long been a standby as a convenient solution for utility stock exposure and income. Now, 40% of the fund's top holdings are in the electrical generation and distribution space, while natural gas, telecom, and cable round out the rest. Now, while shares trade at a premium to the net asset value, or NAV, the fund's lowest price point, historically high yield and historical performance of 9.1% annually over the last 15 years versus the S&P's 500, 7.51% for the same period. This makes GUT a good choice for family members, wealth-astute family members seeking a basket of stocks approach. Now, shares of GUT currently trade around $6.80 plus or minus, with an attractive 8.9% yield. I said 8.9% yield. Gabelli Utilities Trust family members, GUT, Atwwi's Wealth-Astute holding strategy on any and all of these particular positions get paid multiple times. Remember, convergence versus divergence, and you get PAID. Now, collectively, the biggest risk facing all three of these particular positions, of course, would be rising interest rates. Traditionally, utility companies have always relied on debt financing for expansion and operation, as their steady, predictable cash flow is typically sufficient to offset debt service. Now, higher borrowing costs as a result of interest rates rising are always a threat to consistent dividend payments. This goes double for GUT, in that the fund manager, listen to me now, what he does is he employs leverage to juice up returns and yields. That's why you got that 8.9% yield. Again, higher borrowing costs squeezes profits and reduces what the fund can pay out to shareholders. But while interest rates have moved up noticeably, they still have a long way to go before they reach a level at which they become problematic for equity investors. So this is what you want to do. You need to be intelligent, and you need to also be clever. Wealth-Astute family members and listeners alike, combine these three positions, and they then will offer you a blended yield approaching 6%. The inclusion of a closed-end fund offers additional diversification. With cooperative market conditions, upside of 9 to 10% over the next year seems extremely doable. And you throw in a 6% yield, on top of that, and that would result in a total return of right at 15%. Don't you let anybody tell you that there is not yield out there in the market. Yours truly just identified it for you. Get PAID, family. Feel the wealth coming your way. Know that you are the chosen ones. Use this information to not only obtain, but also maintain your economic liberation. Boring utility positions. Positions that provide what society needs and will get your PAID consistently. You're inside the classroom without walls. Up next, the ASK THE WIZ Wall Street ER plays of the day. 14 positions to get your PAID within the next 24 hours.